This video provides an overview of the major concepts covered in Chapter 10, Stock Offerings and Investor Monitoring. Stock markets facilitate equity investment into firms and transfer of equity investments between investors. The 8 major concepts covered in this chapter include describing the private equity market, describing the public equity market, describing the process of initial public offerings, describing secondary offerings and stock repurchases, explaining how the stock market is used to influence the management of firms, explaining how publicly traded companies are monitored, describing the market for corporate control, and describing the globalization of markets. Let's begin with private equity. When a firm is created, its founders typically invest their own money in the business. The founders may also invite friends or family to invest equity in the business. These funds are referred to as private equity because the business is privately held and the owners cannot sell their shares to the public. Like debt, equity can help a firm finance its business operations, but providers of equity become part owners of the firm, whereas lenders that offer debt financing to a firm do not. Private equity can be raised through venture capital funds, private equity funds, and crowdfunding. Private firms that need a large equity investment but are not yet in a position to go public may attempt to obtain funding from a venture capital or VC fund, which receives money from wealthy investors and from pension funds that are willing to maintain the investment for a long-term period such as 5 to 10 years. Venture capital conferences allow for interactions between firms that need private equity funding and VC funds that have the funds to invest. When a VC fund decides to invest in a business, it typically invests in amounts such as $5 or $10 million in exchange for a minority stake in that business. A VC fund typically plans to exit from its original investment in about 4 to 7 years. A common exit strategy is to sell the equity stake to the public after the business engages in a public stock offering. The performance of VC funds tends to vary over time. In periods when stock prices are low, valuations of private companies are low, and VC funds can invest their money more wisely in these companies. However, when stock prices are high, valuation of private companies are high, and VC funds may pay too much when investing in companies. Private companies that need private equity may also consider private equity funds, which receive investments from institutional investors such as pension funds and insurance companies, and invest the funds in the business. Unlike VC funds, private equity funds purchase a majority stake in a business or even the entire company. Consequently, their investment in a business is usually much larger than the typical investment by a VC fund. In addition to using the funds that they receive from institutional investors, private equity firms borrow heavily to finance their investments. This practice enables them to purchase larger companies or to buy more businesses with a given level of equity. Private equity firms look for companies that are undervalued and potentially mismanaged because they can more easily achieve a high return on their investment when buying weak firms that they can improve. Private equity funds can sell their stake in a private business in the same way that VC funds do. If the business conducts an IPO, the private equity fund can cash out by selling its ownership to new investors. Alternatively, it can sell the business to another company. If private equity funds are able to improve businesses to a significant extent, they should be able to sell their stakes to new investors or to other firms for a much higher price than they paid for those businesses. In order to obtain funds from VC and private equity firms, new companies today have the option of trying to raise funds from a large number of investors through a process called crowdfunding. This is done over the internet through platforms such as Crowdfunder, Indiegogo, and Kickstarter. Next, let's discuss public equity. The founders of many firms dream of going public or issuing stock to the public someday so they can obtain a large amount of equity financing to support the firm's growth or pay off some of their debt. They also may hope to cash out by selling their own original equity investments to others. When a firm engages in a public offering, it sells or issues many shares of its stock in the primary market in exchange for cash. The 2 most common forms of stock include common stock, which entitles shareholders to a number of rights, including voting rights, and preferred stock, where shareholders typically give up voting rights in exchange for dividends. This exhibit illustrates the means by which stock markets facilitate corporate financing in the primary equity market. The stock markets are like other financial markets in that they link surplus units, those that have excess funds, with deficit units, those that need funds. Individual investors participate in stock offerings by corporations by purchasing stocks directly or by investing in shares of stock mutual funds, which then use the proceeds to invest in stocks. This exhibit summarizes the behavior of various types of financial institutions that participate in the stock markets. Because some financial institutions hold large amounts of stock, their collective sales or purchases of stocks can significantly affect stock market prices. In addition to the primary equity market, which facilitates new equity financing for corporations, a secondary equity market allows investors to sell stocks that they previously purchased to other investors. Thus, the secondary market creates liquidity for investors who invest in stocks. The next key concept in the chapter relates to initial public offerings, or IPOs. When a corporation first decides to issue stock to the public in an effort to raise funds, it engages in an initial public offering. An IPO is used not only to obtain new funding, but also to offer some founders and VC funds a way to cash out of their investments. The process of going public includes developing a prospectus, pricing and book building, and determining the allocation of IPO shares to various underwriters involved in the IPO. In addition, IPOs incur transaction costs of approximately 7% of the funds raised. The lead underwriter's performance can be partially measured by the movement in the IPO firm's share price following the IPO. If investors quickly sell the stock that they purchased during the IPO in the secondary market, there will be downward pressure on the stock price. Therefore, underwriters may purchase shares in the secondary market shortly after the IPO or take steps to attempt to stabilize the stock's price, including efforts to prevent flipping or selling the stock shortly after it's purchased, over allotment options, which give the lead underwriters the right to purchase extra shares from the issuing firms at the IPO offer price, and lockup provisions, which prevents the original owners of the firm and the VC firms from selling their shares for a specified period of time, usually 6 months from the date of the IPO. On May 18, 2012, Facebook engaged in an IPO and raised about $16 billion with its offering. Because of its popularity, Facebook's IPO attracted a lot of attention. It had 33 securities firms that served as underwriters by selling the shares to investors. These underwriters earned fees totaling approximately $176 million for their services. Based on the offer price, Facebook's market value was about $104 billion at that time, larger than almost all other firms in the United States. Unfortunately, initial public offerings may be subject to several abuses, including spamming, laddering, excessive commissions, and distorted financial statements. Despite the success of many IPOs, considerable evidence shows that, on average, IPOs perform poorly over a period of a year or longer. Thus, from a long-term perspective, many IPOs are overpriced at the time of issue. The generally poor long-term performance of IPOs may occur for several different reasons, including investors being overly optimistic about a business going public and may be willing to buy the shares at any price. Second, the poor performance may be caused by the firm's managers. Sometimes they may spend excessively and waste some of the funds received by the IPO by making bad investments. And third, some firms may have exaggerated their earnings at the time of the IPO in an effort to maximize the price at which the shares could be sold. Now let's move on to stock offerings and repurchases. Even after a firm has gone public, it may issue more stock or repurchase some of that stock that it previously issued. A firm may need to raise additional equity to support its growth or to expand its operations. A secondary stock offering is a new stock offering by a specific firm whose stock is already publicly traded. Some firms have engaged in several secondary offerings to support their expansion. When corporate managers believe that their firm's stock price is undervalued, they can use the firm's excess cash to repurchase a portion of its shares on the market at a relatively low price based on their valuation of what the shares are really worth. Firms tend to repurchase some of their shares when the share prices are at very low levels. The fifth major topic in the chapter relates to stock exchanges. Any shares of stock that have been issued as a result of an IPO or a secondary offering can be traded by investors in the secondary market. In the United States, stock trading between investors occurs on the organized stock exchanges and the over-the-counter or OTC market. An organized exchange is a securities marketplace where buyers and sellers regularly trade securities in the secondary market. The most prevalent exchanges in the U.S. are the New York Stock Exchange, or NYSE, and the NASDAQ, or National Association of Securities Dealers Automated Quotation Stock Market. Approximately 2,400 companies are listed on the New York Stock Exchange, and together they have a market capitalization of more than $25 trillion. About 3,600 companies are listed on the NASDAQ, and they have a combined market cap of approximately $20 trillion. The New York Stock Exchange and the NASDAQ charge an initial fee to firms that wish to have their stock listed, with this fee depending on the size of the firm. Corporations must meet specific requirements to have their stock listed, such as a minimum number of shares outstanding and a minimum level of earnings, cash flow, and revenue over a recent period. Stocks not listed on the organized exchanges are traded in the OTC market. Like the organized exchanges, the over-the-counter market facilitates secondary market transactions. Because there's no trading floor, it's not necessary to buy a seat to trade on this exchange. However, it's necessary to register with the SEC. Currently, 2 OTC quotation systems exist: the Global OTC, Alternative Trading System, and the OTC Markets Group. The New York Stock Exchange and NASDAQ market offer extended trading sessions beyond normal trading hours. A late trading session enables investors to buy or sell the stocks after the market closes. And an early morning session, sometimes referred to as the pre-market session, enables them to buy or sell stocks just before the market opens on the following day. The trading of stocks between investors in the secondary market can cause any stock's price to change. Investors can monitor stock price quotations both in real time and historically at financial websites to obtain the following information regarding the stock's price: its 52-week price range, trading symbol, annual dividend, dividend yield, price-earnings ratio, the trading volume, and the closing price quote. Stock indexes serve as performance indicators of specific stock exchanges or of particular subsets of the market. These indexes allow investors to compare the performance of individual stocks with more general market indicators. The more commonly monitored stock indexes include the Dow Jones Industrial Average, the Standard & Poor's 500, the Wilshire 5000 Total Market Index, and various indexes provided by the New York Stock Exchange and the NASDAQ. Prior to undertaking an IPO, some private firms list their shares on a private stock exchange. In such a form, employees or owners who own shares of these firms can't sell their shares to other investors. The next key concept in the chapter is monitoring publicly traded companies. A publicly traded firm's managers serve as agents for shareholders by making decisions that are supposed to maximize the stock's price. This separation of ownership by shareholders and control by managers can result in agency problems because of conflicting interests. Securities firms often employ analysts who are assigned to monitor a small set of publicly traded firms. These analysts communicate with the high-level managers of the firms that they cover. They publicize their opinion of the companies that they monitor for investors by assigning a rating or recommendation of the firm's stock, such as strong buy, hold, or sell. To the extent that managers of firms can manipulate the financial statements, they may be able to hide information from investors. The Sarbanes-Oxley Act was enacted in 2002 to ensure more accurate disclosure of financial information to investors, thereby allowing them to more effectively monitor the financial condition of firms. If shareholders are displeased with the way that managers are managing a firm, they can either do nothing and retain their shares in the hope that management's actions will ultimately lead to strong stock performance, or they can sell the stock. Alternatively, shareholders can engage in shareholder activism in a number of ways, including communicating their concerns to other investors in an effort to place more pressure on the firm's managers or its board members. Other shareholder activist techniques include proxy contests to attempt to change the composition of the board. They may sue the board if they believe that the directors are not fulfilling their responsibilities to shareholders, and hold companies to account on environmental, social, and governance issues. The next concept is the market for corporate control. When corporate managers notice that another firm in the same industry has a low stock price as a result of poor management, they may attempt to acquire that firm. The market for corporate control is enhanced by the use of leveraged buyouts, or LBOs, which are acquisitions that require substantial amounts of borrowed funds. The power of corporate control to eliminate agency problems is limited by barriers that can make it more costly for a potential firm to acquire another firm whose managers are not serving the firm's shareholders. Some of the most common barriers include adding anti-takeover amendments to their corporate charters that may require at least 2/3 of the shareholders' votes to approve a takeover before the firm can be acquired. Poison pills, which are special rights awarded to shareholders or specific managers on the occurrence of specified events, and golden parachutes, which specifies compensation to managers in the event that they lose their jobs or control of the firm. The last concept in the chapter relates to globalization of stock markets. Stock markets are becoming globalized in the sense that barriers between countries have been removed or reduced. Firms in need of funds can now tap foreign markets, and investors can purchase foreign stocks. In recent decades, the governments of many countries have allowed privatization, or the sale of government-owned firms to individuals. Some of these businesses are so large that the local stock markets can't digest stock offerings, thereby attracting investors from various countries to invest in the privatized businesses. Emerging markets enable foreign firms to raise large amounts of capital by issuing stock. These markets also provide a means for investors from the US and other countries to invest their funds. It's important to note the variation in characteristics that can differ across stock markets, such as the volume of trading activity, shareholder rights, legal protection of shareholders, government enforcement of securities laws, and the degree of financial information that must be provided by public companies. Investors can obtain foreign stocks in three major ways. Investors can easily invest in stocks of foreign companies that are listed on local stock exchanges. Foreign stocks not listed on local stock exchanges can be purchased through some brokerage firms. An alternative means of investing in foreign stocks is by purchasing American Depository Receipts, or ADRs, which represent shares of non-US stock. Another way to invest in foreign stocks is to purchase shares of international mutual funds, or IMFs, which are portfolios of international stocks created and managed by various financial institutions. In this way, individuals can diversify across international stocks by investing in a single IMF. Finally, investors can purchase exchange-traded funds, or ETFs, which trade like stocks and are passive funds that track a specific index. International ETFs represent international stock indexes and have become very popular in recent years. By investing in an international ETF, investors can invest in a specific index representing a foreign country's stock market.